Today we're going to do something a little different than normal. I'm going to show you a project I did for my public speaking class this last quarter at school. Shout out Professor Merle. In some ways, this public speaking class is the reason that this YouTube channel exists at all, so I thought it would be fun to go back and kind of show you where it all started. This video is kind of a speed run of personal finance and investing. The assignment was to make a how-to video that was 5 minutes long. I tried to cram in too much. I think I could cut it down to 6 minutes, but couldn't cut any further. I think it physically pained me to not go into depth on some of these topics. See if you can tell which ones. There's one in particular that it hurt me to just kind of breeze over. Let me know if you can tell and which topics hurt the most. Let me know in the comments. But give it a watch and send me an email if it sparks any additional questions for you. Like I said, I know it goes by fast, so if you do have follow-up questions, send me an email. But I hope you enjoy it. It's kind of fun.
What would you do if you got laid off from your job tomorrow? Would you be able to pay your bills? Would you have to scramble to get a new job right away? How stressed would you be? If just thinking about this question stresses you out, you're not alone. Most people worry about money. But what would it mean for you if you didn't have to worry about it as much? Hi, I'm Jameson. I'm a personal finance nerd with 5 years of experience in the investing industry. And today we're going to talk about the concept of financial independence. It's when you have enough money in investments that you can live off the proceeds and work becomes optional. Another word for this is retirement, but you don't have to fully quit your job to see the benefits of having savings and investments. Every step closer to financial independence means a little bit less stress in your life and more control over your life. It might mean that you can quit a nightmare job, take some time off to care for a sick family member, or retire from working entirely. It's using your money to buy back your time. Okay, but how do you do it? Well, achieving financial freedom is surprisingly simple. You just need to spend less than you make, invest the difference, and eventually your investments will grow to the point where working becomes optional for you. But let's talk about each of those steps in more detail. Step 1, spending less than you make. This creates the fuel to work towards your financial goals. If you're currently spending everything that you make, you'll have to either find a way to cut your spending or to find a way to make more money. If you need to cut costs, look carefully at your housing and transportation costs. These are the two largest expenses most people have, so even small cuts there will have a big impact. Think about things like getting a roommate, getting a smaller place, or driving a used car. Next, automate your savings. Treat your savings goal like they are non-negotiable bills. Set up recurring transfers into specific savings or investment accounts as soon as you get paid, and then spend what's left on your variable expenses. In my experience, you quickly adjust to the new cash flow situation when the transfers happen automatically, and you don't even miss it. It's a good way to take the willpower out of savings. And you want to aim to save at least 15% of your income. Once you spend less than you make, you're going to use that budget surplus to work towards your financial goals. If your employer has a 401k that offers a match, start there and contribute at least enough to get that match. That is free money. Next, you'll pay off high interest debt like credit cards as quickly as you can, but pay off low interest debt slowly. And then buy investments. This step is critical. Investing means your money is working for you. It is the only way to make money other than working, which means it's also the only way to ever replace your salary so you can stop working. But how do you invest? Well, my favorite way is to use a total stock market index fund. You buy one fund, and that fund buys a little piece of every publicly traded company in the United States. You're buying a piece of thousands of companies all at once. You can add an international stock index fund for diversification, and you can add bonds if you want to lower the risk level, but they'll also lower the expected returns. And then buckle up. The value of your portfolio will fluctuate up and down. Market drops happen all the time, and this is normal. When the market drops, just keep buying. You're buying companies while they're on sale when the price is lower. The market has always recovered, though individual companies might not, and that's part of why we buy index funds. And then bonus points if you buy your investments in something like a Roth IRA, because that allows your investments to grow tax-free. Okay, so how do you know when you can retire? Well, when you've saved 25 times your annual expenses, once you get to that number, you are financially free. You can retire when you want to. And I know you're already thinking, that's way too much money. I'll never be able to save that much. And that's why we need to talk about the power of compound interest. This chart shows an example of making contributions of $100 a month for 50 years into an investment that grows about 10% per year. After 50 years, you would have only contributed $60,000. That's the little green line down here. But the account would have grown to over $1.7 million. That is incredible. That's the power of compounding. But the key is to start early. Compound interest is incredibly powerful, but it takes time. The earlier you start, the less you'll have to contribute to reach your goals. This next chart shows the difference between investor in blue over here investing just from age 25 to 35 and then stopping their contributions and letting the investments grow on their own. The investor in orange over here waited until age 35 and then made contributions every year for the next 30 years. But even though they end up contributing, 3 times as much, they never catch up to the investor that started earlier. So it's very important to start early. Even small early contributions can make a huge difference when compounded for decades. But what if you're, wanting to retire earlier? You don't want to wait 30 or 50 years to retire. Well, if you want to get there faster, just save a higher percentage of your income. So retirement might seem like a long way off in the future, and you might be tempted to just not think about it. But please, take some small steps today to build a solid financial foundation. Yes, your future self will thank you when you're sipping on a cocktail on a beach in retirement, but it'll also make your life better now, because every step closer to financial independence will make you a little bit more free, a little bit less stressed about money, and have a little bit more power to build the life that you want. Thank you.